Hi, I'm Warren Buhai, Senior Portfolio Manager in Stanley's multi-asset franchise. I thought I would start this year-end update with a reminder of our investment philosophy and process that has been in place for many years. We remain less exposed to risk assets as a result of us following our investment philosophy and process, which is tried and tested through various market cycles. Asset class selection is critical, and we do not change the way we invest in markets simply because central banks are adamant that printing more money can solve an over-indebtedness problem. We remain vigilant in basing our decisions on underlying fundamentals. While short-term volatility is unlikely to disappear anytime soon, we believe that our current positioning will stand our clients in good stead when this current cycle fully plays out. Corrections in asset prices will give us opportunities to deploy capital at much more reasonable prices. As an example of the current level of excessive valuation in markets, if we look at the US equity market, we see that on long-term valuation measures and normalizing for current high margin levels, the market has only been close to this level of overvaluation during the dot-com bubble of the late 90s and at the back end of the roaring 20s bull market. While we cannot say that the market will not go higher and become even more expensive, one needs to consider how much risk should be taken if you take a step back and consider unemotionally where the market levels are at. Clients' wealth is everything to us, and as we become more worried about valuation levels across most asset classes, we seek to limit the downside and participate in the upside only where there are select and compelling opportunities. So if you look at the 5 big equity market corrections in the US over the last 60-odd years, we see that 3 of the 5 corrections started from valuations lower than where markets are today. This begs the obvious question of how much of our clients' wealth we should be risking in chasing increasingly expensive markets, knowing that history is telling us that the risk of losing at least 30% of that wealth is very high at this point of the valuation cycle. Following the dot-com bust of the early 2000s, the Fed cut rates from 6.5% to 1%, but the equity market still declined 51%. And following the global financial crisis of 2008, the Fed cut rates from 5.25% to 0.25%, but the equity market still declined by 58%. Our concern now is that with global policy rates so low, central banks have no ammunition to support markets that face any type of crisis in the future, following one of the longest expansions in history. We cannot forecast the exact catalyst for a market correction, be it a recession, inflation, deflation, environmental catastrophe, or a fallout from ever-increasing political instability, but we can assert that the pricing of assets does not reflect the risks, and we are not being sufficiently rewarded for putting a substantial portion of our clients' wealth at risk. South African investors are unusually fortunate from a global perspective in that we have a relatively high risk-free return available to us in cash and short-term fixed income markets that gives us a real return in rands with a high level of capital protection. Most global investors have no such luxury, with an increasing amount of negative yielding government bonds, which in turn has forced global investors to take on more risk in trying to generate inflation-beating returns. This is evident in the significant rallies we've seen in many emerging and developed market risk assets from their lows of Q1 this year. Even the dividend yields on equities look attractive relative to domestic risk-free returns in most geographies. However, this search for yield often ignores the underlying deteriorating fundamentals of declining profitability and the increased leverage in corporates, sovereigns, and personal balance sheets. As this chart shows, return on equity for US corporates has now reached the lowest level since 1950, which is clearly in stark contrast to current excessive valuation levels. Since the lows coming out of the global financial crisis in early 2009, our balance funds have generated returns above the normalized rate of inflation plus 5% per annum. Investors need to be cognizant of the risk that future returns will be more subdued following such strong market returns. Indeed, the JSE All-Share Index has been relatively flat over the past 2 years. Equities are now producing returns similar to cash, but obviously with much higher risk and volatility in return profile. Our high cash allocations have meant superior risk-adjusted returns for our clients and a sleep easy factor, knowing that your investments are less exposed to the distinctly negatively skewed potential scenarios from this point in the cycle. In conclusion, while we are clearly living in unprecedented times given the extent of central bank intervention in the market, history teaches us repeatedly that ignoring fundamentals over any reasonable time horizon has been a sure way to destroy clients' wealth. As custodians of our clients' hard-earned wealth and having generated significantly above average real returns, We do not believe that this is the point in the valuation or business cycle to be taking undue risk and potentially jeopardize the wealth that has been created in one of the longest bull cycles in history. At times like this, when certain asset classes are moving aggressively every few months, it is critical to remain patient and calm in waiting for opportunity to deploy clients' capital at better points in the valuation cycle. We strongly believe that protecting capital at the right point in the cycle will lead to better long-term outcomes for our clients. As opposed to hoping that central banks can continue to put a floor under very high valuation levels, we believe it is much more important to realize where we are in the cycle, how good returns have been up to this point, and focus on protecting wealth generated in what has become an increasingly low return world. We believe that our funds are able to generate inflation-beating returns for our clients over various cycles. Currently, wealth preservation is our mindset, which we believe is appropriate for this stage of the valuation and business cycle. We do take opportunities when markets present them. However, we will not take undue risk with our clients' capital in chasing short-term returns that in our view are temporary. Lastly, I would like to thank you for your support during this volatile year and wish you a happy, healthy and prosperous 2017.